the inflation report was released for the month of March, and consumer prices were up 8.5%. So that's up from a 7.9% rate in February. That means, unfortunately, that inflation is continuing to accelerate. I've heard some voices out there saying, oh, well, this is as high as it's going to get. Things should start to slow down from here. I'm not personally convinced, but Psyche, I want to get your thoughts on where this is headed.
Yeah, I'm not convinced either myself. So, uh, in talking about the numbers that came out on the latest report, that's not surprising. We've talked about it on this podcast for the past couple months that we actually expected it to get a little worse. So that has happened. On the positive side, speaking of optimism, the interest rate paid on I bonds will more than likely go up at their next meeting next month. So anybody that has a little bit of cash that they don't want to put in a stock market or excess cash they may have in their emergency fund, don't use your emergency fund cash. But if you built up a little excess, feel free to go out and buy some I bonds. It'll get you an 8.5, 9% return over the next 12 months, it looks like. Um, and that's, I guess, is as safe as you think the federal government is. But
I don't think
yeah,
there will be a default next month, so or
I
even
don't think
12
so.
months.
Yeah, I don't see that happening either. So, yeah, I'm not convinced we're at the peak. Obviously, we all know eventually this is going to subside. I don't feel like we're quite at the peak. I feel like there's a little bit more momentum left. It doesn't seem like the momentum has stopped. I think we're getting closer. At the end of the day, ultimately, that just means, we've got to pay attention to how we spend our dollars and keep our financial house in order.
Well, that's true. And I saw another story today that I think lends some credence to, what you just said, that maybe it's not going to slow down real soon. Wholesale prices were up 11.2% year over year. So, I don't see how you get wholesale prices at 11.2% and you don't see most of that being passed on to the consumer, because otherwise businesses start to fold. People are in business to make money, and they can't do anything except, absorb part of whatever it is they think they can tolerate, but the rest of it they got to pass on to the consumer. And I think there's a reasonably good chance that you're going to continue to see inflation stay high. Now, there's a difference, obviously, between accelerating and maintaining. So, when you think about acceleration, that's 1 month being at 6, the next month 7, 8, 9, 10, 11, so on and so forth. Well, if you hit, say, 8.5, and then you stay at 8.5 next month and 8.5 the month after that, inflation is still really, really, really high, but it's no longer accelerating. The rate of inflation has stabilized. Now, ideally, what we'd like to see is the rate of inflation start to decelerate. So you go from 8.5 down to 7, down to 6, down to 5, until you get back to the goal, which is 2%, is where the Federal Reserve wants it to be. I think that we're a ways away from that, though. And the more I look into it, the more convinced I am that the Fed isn't being hawkish enough. They're talking about maybe doing a half of a point increase in interest rates at the next meeting in May. They did a quarter point in March. Well, I think it's going to take a lot more than that to tame things down. Another thing you and I were talking about right before the show started was the money supply, right? Because that's the main driver of inflation, is how much money there is in the economy. And going back to right when the economy shut down for all the COVID lockdowns, spring of 2020 compared to where we are right now, the money supply in the economy has gone up by over 50%. So that's just staggering. And, so you got to look at, are we going to continue to pour more and more cash into the economy, or are we going to slow that down? If we slow it down, are we going to get to a point where at least we're not, adding into it significantly? And the answer is, I don't see that slowing down for a while. The Federal Reserve, I don't think, is going to be able to pull back enough money out of the economy to significantly slow things down without jacking interest rates up a lot higher than what they're talking about doing. And, the other side of this is the federal government, because they bring in a certain amount of tax revenue every year. Everything that they spend in excess of what comes in tax revenue, they have to borrow that money from somewhere to finance their spending. Now, you can do that through the sale of government bonds. So, the government goes out and says, okay, we're selling this debt. Who wants to buy it? Well, some of us here in the United States might buy some bonds. Overseas, you may have other citizens or governments buy bonds, whatever the case may be. But if the sale of those bonds doesn't bridge the gap, it doesn't cover the deficit spending, well, then what happens is the government goes to the Federal Reserve and says, we need you to buy these bonds, and then we're going to finance the debt that way. Well, the Federal Reserve buys those bonds by creating money out of thin air. And then that money goes to the federal government, who injects it into the economy. So that's the problem. And we're at a situation where the current administration's most recent budget proposal is $5.8 trillion, which is far in excess of what revenues are from taxes. So they're doing extreme deficit spending. Gone are the days, the simple days back in the early 2000s when we were simply running $200 and $300 billion deficits. Now we're running over $1 trillion a year deficits. Well, if the vast majority of that is simply money being printed out of thin air and going back into the economy, I don't think that that's going to help ease inflationary pressures.
The Purposeful Podcast.